Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as...
Tired of the rat race? Dreaming of escaping the 9-to-5 grind? Well, what if I told you there was a secret weapon for financial freedom? A wealth-generating machine hidden in plain sight. I'm not talking about some get-rich-quick scheme or crypto moonshot. No, this is the tried-and-true method of the Oracle of Omaha himself, Warren Buffett. Buckle up, because we're about to crack the code on the fastest way to live off dividends. To start things off, let's grasp the concept of dividends and why they play a crucial role in reaching financial independence. As the investing legend Warren Buffett once stated, "If you don't find a way to make money while you sleep, you will work until you die." Dividends provide the avenue to earn money while you sleep. And here's how it operates. When you invest in a company's stock, you essentially become a partial owner of that company. Now, when the company turns a profit, which we hope it does, it has choices on what to do with those earnings. One option is to share a portion of those profits with its shareholders, and this sharing of profits is what we refer to as dividends. Dividends are typically distributed regularly, often quarterly. Although some companies may do it monthly or annually, they usually come in the form of cash, but they can also be in the form of extra shares of stock, known as stock dividends or dividend reinvestment plans. So, in summary, dividends are your share of the earnings when a company divides its profits with its shareholders. They can be a reliable source of income for investors, making them a crucial tool for wealth building and achieving financial freedom. This is a tactic that Warren Buffett has personally employed to amass wealth throughout the years.
The answer is I do believe in dividends in a great many situations, including many.
Warren Buffett stresses the significance of constructing a robust portfolio. He expresses, "Diversification is a shield against ignorance. It is of little use if you are knowledgeable about what you are doing."
We had more reason to retain all of our earnings. If See's Candy were a standalone company, we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire. We like the companies in which we have investments to pay to us the money they can't use efficiently in their own business. In some cases, that's 100% of what they earn. In some cases, it's 0% of the earn. We own some stocks that don't pay any dividends.
So, how can we construct a potent dividend portfolio? Developing a dividend portfolio that can endure the test of time demands a carefully devised strategy. Let's dissect the essential elements that will guide you in crafting a robust dividend-generating mechanism, just as Warren Buffett advocates. Firstly, opting for dividend-paying stocks. One of the initial steps involves meticulously choosing dividend-paying stocks. Seek out companies with a track record of consistent or growing dividend disbursements. These companies are often found in sectors like consumer staples, utilities, and healthcare. Research plays a crucial role here. Grasp the company's financial well-being, its competitive edge, and its capacity to generate cash flow to sustain dividend payouts. Secondly, diversification. Diversification is a concept dear to Buffett. It involves spreading your investments across various sectors and industries to minimize risk. Don't concentrate all your investments in one area. A well-diversified portfolio is more resistant to market fluctuations. Remember, while dividends offer income, the value of your investments can fluctuate, so diversification acts as your safety net. Thirdly, long-term outlook.
If you had a punch card with only 20 punches, you weren't going to get another one the rest of your life, you would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Buffett is renowned for his extended time frame in investment. He once remarked, "Our preferred holding period is forever." Regarding dividend stocks, this prolonged outlook holds immense value. Dividend earnings have the potential to grow over time, particularly if you reinvest those dividends back into your portfolio. This cumulative effect can substantially enhance your income in the future. Fourthly, evaluating risk. Another principle from Buffett is steering clear of companies burdened with excessive debt or those that frequently reduce dividends. These could serve as warning signs for your portfolio stability. Concentrate on companies with a strong financial foundation and a history of withstanding economic downturns. Fifthly, supervising and adapting. Lastly, routinely assess your portfolio. Companies may undergo changes, and economic conditions can shift. Make necessary adjustments to ensure your portfolio stays in line with your financial objectives. By adhering to these principles, you can construct a robust dividend portfolio with the potential to furnish you with a consistent income stream, helping you attain your financial aspirations. Now, let's shift to practical considerations and calculate how you can genuinely realize your objective of sustaining yourself on dividends. We'll dissect the steps and tactics you can employ to reach that coveted $4,400 per month in dividend income. Remember, the aim is to have your money labor for you, echoing the sentiment emphasized by Warren Buffett throughout the years.
Blue chip stamps when we owned it, or even diversified retain. We wanted them all to be compounding, in effect, be compounding machines. That's why people gave us capital. That's why we put our own capital in.
Let's delve into the initial strategy on our journey towards sustaining ourselves with dividends. Putting your money into blue chip dividend stocks. This approach is comparable to establishing a sturdy base for your financial structure. Blue chip dividend stocks form the cornerstone of numerous successful investment portfolios. These companies are typically well-established leaders in their respective industries, recognized for their financial stability, impressive track records, and dependable dividend payouts. What enhances their appeal for investors seeking income is their reliability. Blue chip stocks usually fare better during economic challenges compared to smaller, riskier counterparts, rendering them a dependable source of dividend income. Quoting Warren Buffett, "The most crucial quality for an investor is temperament, not intellect. You need a temperament that takes neither excessive joy in aligning with the crowd nor in opposing it."
The proper temperament is far more important in successful investing than points of intellect. If you've got a reasonable intellect and the right temperament, you'll get very rich. And if you've got the wrong temperament for it, you'll get done in at some point.
Buffett's valuable advice underscores the significance of consistency and a forward-looking approach when considering investments in blue-chip dividend stocks. Instead of pursuing short-term market trends, concentrate on companies with a demonstrated ability to endure challenges. These established companies often possess competitive advantages, significant market shares, and a track record of consistently rewarding their shareholders with dividends, sometimes spanning decades. By integrating blue-chip dividend stocks into your portfolio, you're establishing the foundation for a dependable income stream that can aid you in attaining financial independence. These stocks offer stability, income, and the potential for long-term capital growth. Therefore, investing in blue-chip dividend stocks aligns seamlessly with Warren Buffett's philosophy of seeking high-quality investments and retaining them for the extended period. It's a proven strategy that can set you on the path to sustaining yourself with dividends and reaching your financial objectives. Hence, consider incorporating some of these dependable dividend providers into your investment portfolio today. Our second approach to attain financial independence through dividends involves investing in dividend growth stocks. Unlike the stable blue chip stocks discussed earlier, dividend growth stocks present a distinctive advantage. They not only distribute dividends but consistently elevate them over time. Warren Buffett's sagacity resonates in this approach. The best investment you can make is in yourself.
By far the best investment you can make is in yourself. If you invest in yourself, nobody can take it away from you.
In the context of investing, this implies seeking companies that consistently invest in their own expansion and are dedicated to increasing their dividend disbursements. Dividend growth stocks are often found among companies operating in industries with significant potential for growth or those offering innovative products and services. These companies prioritize reinvesting their profits into research, development, and expansion, all while rewarding shareholders with escalating dividends. The allure of investing in dividend growth stocks lies in their compounding capability. As these companies boost their dividends year after year, the income received grows not only in monetary terms, but also as a percentage of your initial investment. This compounding effect can markedly hasten your journey to financial independence. While dividend growth stocks may not present the highest initial yields, their long-term potential to generate substantial income is unparalleled. These stocks benefit investors who grasp the significance of compounding and are willing to let time work to their advantage. As your investments grow, so does your income, making it a potent strategy for those aiming to transition to a life funded by dividends. Thus, investing in dividend growth stocks aligns seamlessly with Warren Buffett's emphasis on continuous learning and a long-term outlook. By allocating your funds to companies prioritizing growth and escalating dividends, you're not just engaging in stock investments, you're investing in your financial future. So, contemplate incorporating some of these promised dividend growth stocks into your portfolio to pave the way for living off dividends. The third strategy in our pursuit to financial independence through dividends brings an intriguing twist: covered call exchange-traded funds, or ETFs. These investment instruments can significantly enhance your dividend income strategy. Warren Buffett's renowned advice guides this strategy. The stock market is designed to transfer money from the active to the patient. In the realm of covered call ETFs, patience is indeed a virtue. So, what are covered call ETFs? And how do they work? These unique investment vehicles blend stocks and options, holding a portfolio of dividend-paying stocks while selling call options on them to generate extra income, potentially increasing monthly dividends. Covered call ETFs typically include high-quality dividend stocks forming the core of the portfolio. By selling call options, the ETF accumulates premiums from buyers, distributing this income to investors as dividends. Yet, selling call options doesn't limit potential stock gains. If the stock price rises significantly, the ETF might have to sell shares at the agreed strike price, missing out on added gains. Tailored for investors trading some potential upside for a steady income stream, covered call ETFs are appealing for those seeking increased dividends without excessive risk. They allow extracting more income from existing holdings without altering the investment approach. Examining specific examples, the Global X S&P 500 Covered Call ETF XYLD follows an index tracking S&P 500 stocks, selling covered call options to provide an enticing yield potential. The ProShares K1 Free Crude Oil Strategy ETF, OILK, aims to offer significant income potential for those interested in commodities, utilizing a unique approach combining futures contracts and covered call options on crude oil futures contracts. The iShares MSCI Brazil ETF, EWZ, though not a covered call ETF, exemplifies a traditional ETF investing in Brazilian stocks. Consider covered call ETFs concentrating on specific global markets, like Brazil, for diversification in your dividend strategy. In summary, covered call ETFs provide a unique approach to income generation and investments. Following Buffett's advice to be patient and understand the trade-off between income and potential upside, incorporate these ETFs into your portfolio alongside other dividend strategies for diversified income and a potential faster route to financial independence. Now, let's simplify the math for reaching a $4,400 monthly goal through covered call ETFs with a 12% yield, compared to traditional dividend investing. To generate $52,800 annually with a 12% yield, the required investment is approximately $440,000. In contrast, using a more common 3% dividend yield, you would need a total investment of about $1,760,000 for the same annual income. With a 3% yield, investing $176,000 in traditional dividend stocks yields an annual income of $52,800. Comparatively, achieving a $4,400 monthly income with covered call ETFs at a 12% yield requires a $440,000 investment. Traditional dividend stocks at a 3% yield demand a significant $1,760,000 investment for the same monthly income. Notably, covered call ETFs offer higher yield potential, appealing to investors seeking income with a smaller initial investment. However, consider risk factors, as covered call ETFs may limit capital appreciation compared to traditional dividend stocks. Diversification, financial goals, and consulting a financial advisor are crucial in tailoring your strategy. Whether opting for covered call ETFs or traditional dividend investing, the journey to living off dividends is a marathon, aligning with financial goals and risk tolerance.